Welcome to Money Hangout. We this is our weekly interaction with you, where we explain about something prominent, something that is happening around us, causing anxiety, an investment issue, and then savings and investment issue, and we try and help you understand or learn more about mutual funds. Uh, this is brought to you by Birla Sun Life and Value Research every week. Today we are going to talk about how to profit from fixed income. Since demonetization, the fixed income market, the bond market has seen big upheavals, big ups and downs. And primary thing was that interest rates will now decline in an accelerated way. That is why bond prices, since the day of demonetization, started going up. The yield crumbled simply because the banks will be flush with liquidity. And then last week, RBI said that it is going to really mop up the complete liquidity by way of by increasing, the CRR, 100% CRR. So all the money that was finding its way into the bank, the RBI has taken it off, in a sense that the bank has to keep it as cash reserve ratio, and rightly so, because this is actually not a long-term deposit. This is a short-term thing, and this is triggered by a government policy. And the moment investors or depositors want to take their money out, they should be able to take it out. So RBI has provided for this simply because the banks have complete liquidity. They are not. It should not be considered as a long-term deposit for making for taking credit. We have seen these two actions: demonetization and absorption of CRR, or increased CRR to the tune of 100%, has caused big, that the bond prices gained dramatically, and then soon after this announcement, they fell. But it has big, implications for all fixed income investors. India remains a dominantly a fixed income country. Most people invest in fixed income. Equity is still not a way of life. So let me just explain, what are the opportunity arising out of the current situation, and how you can profit from it. Broadly speaking, there are three kind of, fixed income fulfill three needs. One is that one is the very basic one, that there are investors who want to derive income from their investment. You make a deposit, you make an investment, and it generates a return. It generates a predictable return. It generates a fairly even return, and it is not, yeah, and you can bank on it in a reasonable way, and you depend on it. That is what, senior citizen savings scheme does. That is what a fixed income fund does. That is what a post office MIP does. Uh, from For those investors, there is a, fixed income continues to remain the first stop, and to a reasonable extent. But you need a different strategy with the changing times, because interest rates will come down. If you invest in bond funds today, or if you move your money from deposit to these bond funds, the dynamic bond fund and the income fund, you will benefit substantially. In fact, in the last 1 year itself, ever since the rates started coming down, the bond funds have actually today, in the past 1 year, have yielded about 15%. And my sense is that, it may not be 15%, but you can expect 1.5 times. I would expect 11, 12, 13%, because rates will come down and these bond funds will benefit. They will gain, bond prices will go up, and you will generate more return. But the natural fallout of this is that you will have to eventually reconcile with lower return, because interest rates are coming down, and these bond prices, which will appreciate for now, will start yielding lower. New issuance will start yielding lower return. So you need to really prepare for this. The only thing that comes to my mind is that use this opportunity to enhance more return. The more return that you generate, use that opportunity to move a part of your money to equity if you have no equity exposure, because in the long run, equity is going to be the only thing, only allocation which will be able to protect the worth of your capital, or help you enhance, less periodic, less bankable, even with greater volatility, will be able to help you optimize your return. Because if you keep all your money in fixed income, the money will remain, your capital will remain constant, and the return will come down over a period. But that is something which you have to worry about it 3 years from now. The second need which is fulfilled by fixed income investments is for that investor who does not, one is making a long-term investment. You don't need the money right now, but you are likely to need that money in 1 year, 2 years, 3 years time. And for that, you are not depending on any, you're not expecting any income. But you're risk averse. You know that you need the money in a defined time frame. And for them, I think this is a great opportunity. You will be able to optimize or enhance your returns substantially, and this looks like an opportune time. Once again, dynamic bond fund, income fund are great investment, and it'll actually be uh, far more rewarding if your time frame is about 3 years. For all risk averse investors, 3 year investment time frame actually enhances your return substantially because you are able to convert all your gains from these bond funds into capital gains. And post indexation, the tax rate turns out to be far lower. So anybody who is in the higher tax bracket, indexation and lower tax rate actually makes fixed income fund very compelling. The third role which a fixed income investment plays is, providing stability to your growth investment. If you are investing in equity and you get very upset with big ups and downs, a 10%, 20% allocation to fixed income moderates your volatility, lowers the risk. The whole portfolio doesn't go up and down very substantially, and you are able to derive that comfort. In fact, there are the pre-packaged ways of doing it is, if you invest in an MIP, which has about 10-15% into equity, or the balance fund, which are dominantly growth investments, 60-65%, or generally about 70% into equity, remaining 30% into fixed income. And I think there investors have a huge opportunity. My understanding of, the outlook for next 1.5 years is that there'll be great uncertainty about uncertainty caused in the market with a lot of events lined up. First is the demonetization, and the after effect of demonetization itself will lead to a lot of ups and downs in the market. 3-4 years down the line, I'm very optimistic about the market, but before that, next 1.5 year, you will see market going up by 2-3% every week, or going up by 2-3%, and it will be very difficult to figure out what to do. So one is that having that 30% allocation to fixed income in a fund itself provides you great comfort. Then comes these funds are able to benefit from this opportunity caused by volatility. They are able to rebalance more often. And my take is that the balance fund will produce higher return than even an all equity fund over the next 1.5 years if they are able to leverage on this rebalancing very often. And most balance funds rebalance it at least on a weekly basis, and generally on a daily basis, and that happens in a very tax efficient manner. So if you are thinking of getting started, or if you are getting unnerved by your big ups and downs in your equity portfolio, maybe get into this. You should consider moving your money. Of course, when you move your money, worry about the taxes. Make sure that your investments are over 1 year old, so that there is no tax implication of moving your money. You will be getting into less volatile asset, at the same time growth oriented, and it'll remain tax efficient. So that's another way of combining fixed income in your equity portfolio to simplify without any meaningful without any hard work.